Hi, everyone. As you know, the tax law changed this year, and there are some great benefits in the new law, but it also imposed some restrictions that could block access to those benefits. And with the end of the year sneaking up on us, we need to act now if we want to win this tax planning game for 2025 and hopefully years beyond. You know, when you think about it, taxes pile up. When you think about federal taxes, state taxes, Social Security taxes, IRMA taxes for people who are receiving Medicare. There are net investment income taxes. There's the alternative minimum tax. Taxes come at us from everywhere on the federal stage. And as a result, they are by far the biggest and most significant expense that most families have over their lifetimes, more than what you would pay for your home, et cetera. So managing this mountain of taxes according to a strategic plan just really makes sense when you think about it. And in a world of volatile markets and volatile investment markets, protecting more of your wealth from taxes is a safe and more predictable way of adding after-tax return to your net worth rather than dialing up a more risk-oriented portfolio. Hi, my name is Mike Hengehold, and I'm a partner with HCM Wealth Advisors. I've spent most of my career helping people plan for an efficient tax life, and I have three goals today for our time together. The first thing I want to do is encourage you to think about which fork in the road you want to be on when it comes to your tax burden. You know, based on my experience, people struggle between the pay as little as I possibly can today road and the pay a little more now, but less over the long-term road. And I guess, to be honest, there's a third road that a lot of people choose to take, or maybe they don't choose to take, they take it by default. And that would sort of be the duck and cover road, where they simply pay their tax bills as they come along without the benefit of any planning. But I suspect all of our intuition tells us that's probably not the best road to take. Anyway, my second objective is to review the new individual tax changes out of the law that was passed earlier this year, primarily the ones that will likely affect HCM clients. And finally, I want to cover the strategies and tactics that are most likely to help HCM clients so that you can decide if you would like to schedule a year-end tax planning meeting with your advisor, if you haven't already done that, to dig in a little deeper and see if a little planning might help. So with all that said, let's get on with the show. So with that said, what I would like to do is go ahead and focus on what we want to accomplish today, those three goals. And the first one is to recognize the fact that we can't be a sitting duck. The law does provide new deductions. However, there are time restrictions and income limitations that are going to have an impact on how we can take advantage of these deductions. And we have to recognize the fact that as I said, we have a limited amount of time between now and the end of the year to make these decisions and to take actions if necessary. So there are some questions that we need to ask ourselves as we come up on the balance of the year. The first is, will I itemize deductions or will I use the standard deduction this particular year? And do I want to try and straddle with that by bunching deductions in one year and moving to the next? Will the phase outs be a problem for me? As I said, the new tax law provides phase out limitations. Is that going to be an issue or not? Will the time limits be a problem? So there are these deductions that came into the law are generally only here for a couple of years, and we want to be able to take advantage of them while they're here. If we're collecting Social Security, do we have IRMA limitation problems? In other words, everybody who collects Social Security realizes that if your income goes above a certain threshold, that your Medicare premiums start to rise. And so as we're doing tax planning on one side, we don't want to create a problem on the other. For future required minimum distributions, are they going to cause our income to spike needlessly? In other words, can we do something today in a lower tax bracket to help manage that problem in the future? Will retirement plan contributions or Roth conversions help from a planning perspective? And something that's going to be more important this year than it has been in the past is thinking about charitable deductions. We're going to talk about this more in a little bit, but there are some new rules that allow non-itemizers to take charitable deductions. That'll begin next year. But when that happens, if you're an itemizer, you're going to get a haircut on your charity. So we want to think about how charitable deductions fit into our overall plan. And so basically our job between now and the end of the year is to do those things that we can't fix later if we can't get them done. So unfortunately, needlessly, as we go through the tax presentation, there's going to be gibberish that will come out. And it's important to understand to some extent what these words mean, because they're important to our discussion. So something that you're going to hear a lot is AGI or MAGI. People also pronounce that MAGI. If you just think of this as being all your income, that's fine. Just if you totaled up all your positive income and said, that's my adjusted gross income, we're in good shape. Then there's two kinds of income that we have, and this is really important from a planning perspective. There's ordinary income, which is the worst kind of income. And the reason I say it's the worst kind of income is because it is taxed at your highest marginal rate, whereas preferenced income can take advantage of lower rates. And so the goal is going to be to kind of balance between those two. When we think about preferenced income, we're thinking about things like long-term capital gains, municipal bond interest, qualified dividends, opportunity zone investments. The exempt portion of Social Security would be considered a preferenced item. Roth IRA distributions are tax-free. Of course, you had a taxable event before to tee that up, but still an important element for income planning, and tax-deferred accounts when they're properly managed. We have above-the-line deductions is a term that's going to be thrown around. Again, very important, because above-the-line deductions reduce your adjusted gross income. If we have an above-the-line deduction, we must have a below-the-line deduction, and the below-the-line deduction is primarily going to be itemized deductions. So these are items that you would take, like mortgage interest, like taxes, like charitable contributions, that you take after the calculation of your adjusted gross income to arrive at your taxable income. And there's a new deduction. This between the line is my term. You're not going to find it in a book anywhere, but the new deductions that are provided by the law that was passed this year they're not itemized deductions. In other words, you don't have to itemize to take them, but they also don't reduce your adjusted gross income. So they're sort of a new animal that's going to take a little bit fresh thinking in how they're used. SALT, this is a term that's been thrown around a lot over the last couple of years. That's short for state and local taxes. Big changes here for people who are being blocked out from taking a lot of their state and local tax deductions, big advantages there. DAF, donor advised funds. A lot of our clients use the donor advised funds in order to make their charitable gifts from a planning perspective, because it allows you to make a big gift to manipulate your income, but continue to give to charity over a period of years, just like you would have done anyway. Things familiar to people with IRAs are RMDs, RBDs, and QCDs. So we've got required minimum distributions. When you get to be of a certain age, the IRS makes you take money out of your IRA. And when they make you take the money out of your IRA, you have to pay the worst tax on it. It comes out as ordinary income. RBD is the required beginning date. That's when you have to start taking the RMDs. And finally, QCDs are qualified charitable distributions or qualified charitable deductions. They're important because they can help reduce your required minimum distributions and effectively keep it out of your AGI. So it helps, it's a tool to help manage your worst income, the highest taxed income. Now, from a tax planning perspective, what's our objective? Well, two roads diverged in a wood. So we're coming up on a fork in the road, and we have to decide from a planning perspective which fork it is we want to take. most often when people come in to talk about tax planning, their objective is how can I drive my current tax bill down to its lowest possible level? And that is an okay way to do things. However, the alternative and probably the better way to do things is to reduce your long-term sort of lifetime tax burden by managing tax rates so that you don't wind up paying nothing today, but a lot more in the future. Better if we can even that out over time. So there might be a third choice that's a little bit better, and that is to do a little bit of both. And so we kind of get into a pay me now or pay me later type of decision. When we think about clients, particularly people who are sort of IRA millionaires, it's important to remember that if we're going to win the tax game, that Uncle Sam has his money in your IRA, his money in your 401k plan, his money in your annuity. So pretty much all tax deferred accounts, you're holding Uncle Sam's money in that plan. How much of that is yet to be determined. So that part has not been chiseled in stone. You still have control over that. And of course, that is the objective of tax planning, especially of longer term tax planning. So the amount that you keep depends on how and when you decide to share it with him. If you take the money out of your qualified plans, your deferred accounts, when you're in an otherwise high tax bracket, Uncle Sam is going to get a bigger share. So if you take the money out when you're in a 32% tax bracket, Uncle Sam is going to get a third of your worldly wealth. If you can take it out when you're in a 12% tax bracket, Uncle Sam's going to get about 10%, just a tad more than 10% of your worldly wealth. So what we're trying to do is manage the levers in order to lean that out so that Uncle Sam gets less because we take a long-term perspective as we plan. Now, we live in what I call a more tax system. The official term is a progressive tax system. And basically what that means is the more money you make, the higher percentage of those earnings are lost in taxes. That's not entirely true, though, because we have different kinds of income. As I said a minute ago, we have ordinary income, which is the worst kind, and that's what the more tax system applies to. But we also have tax preferenced income, which has a different type of tax calculation that's applied to it, or different types of tax calculations, I might say. So we have things like IRAs, we have things like wages, earnings, people have rental property rents that come in. These are all things that are taxed as ordinary income and get taxed at your highest marginal rates. So the trick here is to stay out of those rates if possible and get some, and especially gain some when you gain flexibility in what I call the valley years. Now, this is harder to do when you're working because your paycheck comes in and it's going to be taxed, and it's harder to do after you reach your required beginning date when the RMDs start, because there's a calculation that's going to tell you exactly how much income you have to take from these qualified accounts. But there's that period of time between retirement and when the required distributions start, when you have a great deal of flexibility. I like to think of it as sort of the wild west of tax planning, and that's these valley years. So again, to think about it, we have these parallel tax systems that are running at the same time. So we have the one that we're all familiar with, where our worst income is taxed, but then we have special rates for capital gains. We have special rates for qualified dividends. If we have a situation where we might be in a 32% worst tax rate, we could have capital gains and dividends taxed at about half of that. If we structure our tax situation right, we can have almost $140,000 of income and pay no income tax at all by putting the pieces together properly. So that's basically what we're trying to accomplish. So let's play Beat the Tax Man. So every game needs rules, and these are the rules for playing Beat the Taxman. The first thing we need to do is project our top marginal tax rate after required distributions begin. This is going to generate, obviously, forced income or forced cash flow on us. Sometimes we want all that money, so there's really no problem. Sometimes it's more money than we need, and what happens is it drives our tax rates higher, our marginal tax rates higher, and that's what we're trying to tackle here. So we need to know what that rate is. And then from the bottom up, we want to fill up strategic income blocks. So the first thing that we want to accomplish is filling up the 0% tax rate. So we want to estimate what we think our deductions are going to be, either our itemized deductions or standard deduction, depending on which you're going to use. And the reason that we want to do that is we can burn up a lot of our worst income against those deductions and effectively be starting at zero rather than having to recognize that income later. The next thing we want to do is fill up our 10 and 12% brackets, probably with ordinary income, depending on somebody's particular circumstances, maybe preferenced income. But the whole point is to figure out how much cash flow somebody needs, look at the balances in their tax deferred accounts, and see how we can put those pieces together to keep the long-term tax rates relatively low. Then there's the part where we basically get trapped. So if you do have big IRA accounts that are going to throw off more income than you want, you are going to have to pay the highest marginal rate that's forced on you as a result of the required minimum distributions. And of course, what we're trying to do before that point, while we're in the income valley, is make that amount as small as possible. Once we get that done, then the goal is to fund the remaining cash flow needs to the extent that we can, assuming the assets exist, with discretionary tax preferenced income. What this does is it allows us to access the 0% tax rate, the 15% tax rate, and then because we're dealing with investment income, we may wind up at an 18.8% tax rate, which is a combination of the capital gains rate and the net investment income tax, and the 23.8% tax rate, which is a combination of the 20% capital gains rate and the 3.8% net investment income tax. In all cases, though, when you get into those higher investment taxes, the odds are that your worst tax rate, in which your highest marginal tax rate, is going to be substantially higher. So it's going to be a lot more efficient to be paying tax at these levels than it will be at the ordinary income rate. Okay, so now what I'd like to do is talk about the new tax act that was passed this year. It goes by the name, the One Beautiful Bill Act. It was passed on July the 4th, was signed into law then, and the bill is certainly big. Whether or not it's beautiful or not, I guess, depends on your perspective. And although we regularly hear that this is for millionaires and billionaires, I think what you're going to see is that with its limitations and phase outs, it really was pretty effectively designed to help sort of what I would consider to be regular people and not the super wealthy. I'm going to focus my attention today on those items that are most likely to affect HCM clients. So my purpose is not to go over every single change in the law, but to look at those things that are likely to affect our clients. And I'm going to hopefully mention the other things quickly that may impact clients at the fringe. At least that way you'll know they're out there, and you can give us a shout if you'd like to talk about that further. So the first three that kind of go together are an extension of the tax bracket structure. So if you think back several years to the end of 2017, we passed the Tax Cuts and Jobs Act that brought in lower tax rates, and they were all supposed to expire at the end of 25. And what the current tax law does to a large extent is take a lot of those benefits and make them permanent. Of course, permanent is until the next administration changes them, but for the time being, their expiration is no longer a risk. It'll just depend on legislation. So we've got the extension of the tax brackets. We've got higher itemized deductions. They were scheduled to be reduced, and they've been extended and increased a little bit, but the extension is the big thing. And then the first deduction I'm going to talk about is the senior deduction, and to see how all that plays together. So what this chart shows us is for a senior person, and so you can see if you look at the colors here, we've got the first bar is for a single, the second is for a married filing joint with one person over 65, and the second bar, the third bar of the chart, is for a married couple with both spouses over 65. The solid blue at the bottom shows you what the standard deduction will be. That blue section, the light blue section, shows you the additional deduction that taxpayers receive if they are in fact, over 65. And that top green part is this new deduction that people get also by being over 65. Now, the green part is subject to some pretty stringent restrictions, which we'll talk about in a bit. But I wanted to see sort of how these pile up. And you can see over on the right that a married couple who are both over 65 get almost $50,000 worth of deductions. And this is, I mentioned earlier, only about 14 or 15% of people are suspected to itemize. And this is the reason why. You don't have to keep any records, don't have to keep track of deductions or medical expenses or interest payments, anything like that. The government is typically going to give you credit for these deductions, whether you have them or not. And so that's helpful. So this gives you a feel for the over 65 deduction and the itemized deductions, to get a feel for what the extension of the tax rates do. And I'm going to turn on my pointer here because this slide is more involved than it needs to be. You can see what we've done here is said for single taxpayers, if this person had $75,000 of income, and we chose 75,000 because there's no phase out of the over 65 deduction at this level. So if somebody had $75,000 and they were not over 65, we can come down and see that their tax would be $7,670. So basically what's happened is we started at $75,000. We got a standard deduction of $16,100, generating a tax of $7,670. And don't be distracted, that this is a little bit different than the chart I showed you before. One was for 25, this is for 26. There's an inflation bump in there. If this same taxpayer was over 65, in other words, if they were a senior, they would have the same $16,100 deduction. They get that extra layer for being over 65. Remember, we talked about this extra amount being in here. So this person's going to receive that benefit, and that deduction has been around. It's going to be a tad higher next year because it gets a $50 inflation bump. And here's the big one, it gets an extra $6,000 worth of this senior credit or senior deduction, resulting in a tax of $5,900. And over here is if the new tax law had not passed. So what we can see is that the person who is below 65 is saving about $2,200 in taxes, and the person who is over 65 is saving about $3,200 in taxes. Now let's take this a step further, and let's assume this same taxpayer made $150,000. Well, we've got the same itemized deductions, and we've got the same that thin layer of additional deduction for being over 65, but that $6,000 deduction has now been phased away to only $1,500. This is what I was saying earlier. These benefits are geared really for average people. Higher income people see a lot of these benefits phased away as their income goes higher. But looking at the tax savings, nonetheless, the typical single taxpayer who is not a senior tax bill is going to be $24,000. That's about $4,300 less than the tax had this legislation not passed. And the senior tax is going to be about $5,200 less. So in all cases, the extension of the tax rates helped people pay less in tax. If we take that same scenario and look at this for a married couple, we've got the same basic scenario. We've got a higher itemized deduction. We've got a slightly increased because of being over 65. And if the law had not passed, the standard deduction would have only been $16,500. Coming down to the bottom under this scenario, the couple who are not 65 are going to save about $4,300 in taxes. Their bill's about $15,300 compared to $19,006 without the new law. And the couple that gets this extra $12,000 deduction, their bill is going to be roughly $12,000. They're saving about $7,600 or $7,700 based on the legislation. So in all circumstances, the extension of these rates helps. So what else is in the mix? Well, charitable deductions, that's been changed and how they're going to be handled starting next year. We'll go into this in more detail in a minute, but there are benefits for people who don't itemize that'll pop up next year. The state and local tax deduction, this is a big change for people who have bumped into this limitation. Again, we'll cover that in more detail. If you bought a car and borrowed money this year, if the car was put together, if it was assembled in the United States, you may be able to deduct your car interest. This is something that was not the case before. The new between the line deductions, we talked about that a little bit. These are sort of positioned funny because they don't reduce adjusted gross income, but they do reduce your taxable income, and you don't have to itemize to take them. Trump accounts, newborns are entitled to $1,000 Trump account beginning, so you can open the Trump account July 4th of next year, and then you can add to these accounts, in addition to the government's $1,000 seed money, you can add money to these accounts every year until a child is 18. Whether that's a good idea or not goes beyond the scope of the tax planning, but that's something you want to think about when you consider what your other options are. Child care credits, some additional flexibility there. Extended 529 plans, same way. And estate and gift for those who have estates large enough to be concerned about this. The expiration of the Tax Act would have dropped the amount that families can pass substantially. Now the permanent amount has been set back at $15 million per taxpayer. So a couple can move $30 million with proper planning going forward. And again, this is until somebody changes the legislation. So it's not something to go to sleep on, but we do have more time to plan for estate and gift transfers. We mentioned this earlier, but we have to work around the phase outs and time limits for the new tax law. So let's talk about the next one of these, charitable gifts for non-itemizers. This is a very cool deduction. It's modeled after something that existed a couple of years ago. And what it does, beginning in 26, taxpayers, if they're not itemizing, will be able to deduct $1,000 for single and head of household and $2,000 for married filing joint. So this is one of these sort of between the line deductions in that it's only available to non-itemizers. If you itemize, you've got a whole other set of rules to contend with. And although we haven't gotten there yet, there will be a 5% floor next year applied to charitable gifts. This deduction for non-itemizers doesn't suffer that floor. And the one wrinkle is the contributions have to be in cash. So you can't transfer appreciated securities, which of course is one of our favorite tricks because when we do that, we avoid the recognition of capital gains taxes and we get a full deduction of fair market value. Finally, you cannot use these, you can't take these gifts, the $1,000 and $2,000 contribution, and put them into a donor advised fund. It has to go to a public charity. So that's for non-itemizers. For itemizers, starting next year, we're going to have to reduce your charitable deduction by 0.5% of AGI. So here's the gibberish again. So adjusted gross income, remember, that's basically everything you make. So if somebody makes $100,000, the first $500, excuse me, of your charitable deductions is non-deductible. That limit is applied before the AGI-based limitation. So normally, if you just write checks, you would be subject to the 60% limitation. What this basically says is that if you make big charitable contributions in any one particular year, you can't wipe out your whole income with it. You can only wipe out these percentages depending on the type of gift you're making. So if you're giving money to the Red Cross, if you're giving cash to the Red Cross and your income is $100,000, you could deduct a $60,000 contribution. If you're putting appreciated securities into your donor advised fund, you can only deduct $30,000. That's how this mechanism works. That's been around for a long time. Nothing new there. It's just that this limitation is applied before you get to that spot. There is an itemized deduction cap as well. It's not really directly on top of charitable contributions, but charitable contributions are an itemized deduction, and this cap will limit the benefit that you can get from all of your itemized deductions. A little more on that later. Here's an example of how this works. So if somebody makes $200,000 and they give away $75,000 of appreciated stock to their donor advised fund, remember we mentioned that's a 30% limitation, then the 0.5% AGI floor, so 0.5% of $200,000 is $1,000. So our deduction goes from $75,000 to $74,000. Not a terribly big haircut when you think about it. Then the second limitation, which gets applied later after you do that calculation, 30% of our $200,000 adjusted gross income is $60,000. So that's our maximum deduction we can take. So we had $74,000 that was deductible, $60,000 that we can actually take this year, so that other $14,000 gets carried over to next year. And then we're going to, when we get to the next year, we're going to rethink about these limitations again, but you get the gist of how it works. So that's charities. The next biggie for people that were affected is the SALT deduction. And this really is big because the deduction for state and local taxes had been limited to just $10,000 for the last several years. So someone who's working, paying real estate taxes, you put those things together, it's likely that their total tax bill that they paid for these sort of SALT type deductions far exceeded $10,000, especially people who have a second home. Real estate taxes start to pile up. So the new law has moved that cap from $10,000 to $40,000, and it's good through 29. So the deduction begins this year, starts in 25, and will carry for the next several years. So it applies to all taxpayers. When we get to 2030, we're going to fall back to the old law. So this is one of these things that terms out. Probably what will happen is it'll be a problem for another Congress to deal with. People don't like to have these things snatched away. But nevertheless, we've got just a couple of years for this to happen. And again, high bracket taxpayers lose the deduction. So this phase out is much higher than the one for the senior deduction. But you can see if you have an income between $500,000 and $600,000, you're going to lose this deduction. You're going to lose this excess deduction, and it's just going to roll back to the $10,000 threshold that's existed for the last several years. Same concept, just a lower threshold for married filing separate taxpayers. So I did want to touch on miscellaneous itemized deductions. Not going to go into a lot of detail here because I don't think that they're the type of thing that's going to have a big bearing on HCM clients, but you should know they're here in case they do involve you. You certainly can reach out and we'd be happy to go into more detail. So casualty losses, the big change here is that in the past, the federal government had to declare disasters in order to have them provide tax deductible expenses. Now state and local governments can do that. There are new limitations on gambling losses. Gives you a little bit of a haircut with regard to what you can actually deduct. Mortgage insurance, if you pay private mortgage insurance, you're still subject to overall mortgage limitations of the $750,000, or if you have a little bit older, $1 million threshold. But if you're within the threshold, then the mortgage insurance premiums are going to be considered mortgage interest and therefore deductible as you try and build up to the new itemized deductions. And teachers have some additional ability to take educator expenses as itemized deductions. So we talked about these between the line deductions not affecting adjusted gross income or not reducing adjusted gross income. Why do we care? And the reason is that adjusted gross income is the foundation for so many of these extra taxes or additional taxes that we face when we do these calculations. So I'm going to turn this on here. So when we talk about Medicare premiums, I can tell you that nothing aggravates a tax client more than after the fact to find out that their Medicare premiums are going to go up for the next year because they tripped over an IRMA threshold. These IRMA thresholds aren't listed in a tax return. They just sort of come back and bite you a couple years later, but they are based on your modified adjusted gross income. The amount of your Social Security that's going to be taxed. So Social Security can either be free, half of it can be taxable, 85% of it can be taxable. That determination is based on modified adjusted gross income. The net investment income tax on things like interest, dividends, rents, royalties, and so forth is based on your modified adjusted gross income. If you have medical expenses during the year and you were hoping to deduct them as an itemized deduction, you're facing that 7.5% AGI floor. We talked about the new charitable deduction limitation under the new tax law, 0.5% of AGI floor. The SALT deduction, state and local taxes, but it gets phased out based on your adjusted gross income. And on. We saw when we looked at that tax calculation, the age 65 gets phased out fairly early. So it's just important to appreciate that we're getting these deductions, but we still may wind up losing some of the benefit because if AGI is high, these phase outs can kick in or other taxes may apply. Now, one of the big features of the new tax law is that no tax on Social Security. How many times did we hear that when the law was being marketed to everyone? So just have something to take a look at here.
No tax on Social Security.
No tax on seniors' Social Security.
No taxes on Social Security.
We're going to have no tax on seniors' Social Security.
No tax on Social Security.
Lowering taxes on Social Security.
No tax on Social Security for our well-deserving seniors.
Last month, I signed one big, beautiful bill and allowed no tax on Social Security for our great seniors, okay? So how's that? Not bad, right?
Well, I'm sorry to say that the new tax law doesn't do anything with the taxation of Social Security. It leaves it completely untouched. What we did get, however, was a new age 65 plus deduction. Again, it has nothing to do with Social Security. So if somebody is 63 or 64 and collecting their Social Security, still fully taxable. If somebody is 67 and collecting their Social Security, but making income above the phase-out threshold, still fully taxable. That doesn't mean that this isn't a great deduction. It just means it's not what many clients expect to hear as we've been talking to people about taxes. So I make it very clear that this is just another deduction for people who are 65 or older and has nothing, again, to do with Social Security. It's available, starts this year. So from a planning perspective, if you would otherwise get the benefit, but you're creeping up on the phase out period, some planning may be in order. The deduction is $6,000 for an individual. That's for a single person, or if there's a married couple with one that's not 65 and one that is 65, then that person would get it. Otherwise, the couple gets a $12,000 deduction. As I said earlier, it phases out pretty quickly. It phases out in $100,000 range between, pardon me, $150,000 and $250,000 for married couples, $75,000 to $175,000 for other taxpayers. It is in addition to the standard deduction and the age 65 or blind deduction. We saw that before in those bar charts. They sort of build from the bottom up. You get the standard deduction, then you get the age 65 and blind. That's not subject to phase out. And then you get this additional $6,000 deduction that can be phased out. As we've said multiple times now, it doesn't reduce adjusted gross income. So you still have to be concerned about the taxability of Social Security, Medicare, IRMA, and those other taxes that we talked about. So the pro tip here is to, if you're on the bubble for any of these taxes, or particularly the $6,000 deduction, you may want to think about managing your income a bit so that you don't get caught in that trap. This just gives you a picture. I'm not going to stay here long. I just want you to get a sense. This is a chart that shows the phase out ranges of these various deductions. So you can see the deductions are sort of listed down the side, and you can see the level of income that's going to cause you to lose the deductions. You know, we've talked about this age 65 deduction a lot. You can see here that that is, just as you look down, starting at $75,000. This is the earliest, but you can see that all of these, by and large, have phase out ranges that you have to pay attention to. So we talked earlier about the importance of filling up low brackets. This is how we think about this. So again, we talked about filling up the 0% tax rate. One option there is to do that with qualified dividends and capital gains. You can see that you can have up to nearly $100,000 of qualified dividends and capital gains, all taxed at zero. There's a separate 0% amount protected by your standard deduction or itemized deductions. Then we start building the 10% rate. You can see that goes out to roughly 12 and 13. Now, I don't have to read the chart to you. You can see how it goes. What I wanted to do was point out these couple of spaces, lines that don't have numbers outside, because this is where we typically try and do our extra work. The worst income tax rates are the ones that we know. And I stopped this at 24% because typically this is where most of the engineering would finish out for our clients. The next tax rate is going to be upwards of 32%. So there's a big jump there. Here we would want to fill potentially the, so we had the opportunity to take a 0% capital gains rate up through $100,000. Then these other rates would fill in, and because they're lower, we would fill those first. Then the next long-term capital gains rate comes in at 15 or 18.8, which again is the 15% rate plus that net investment income tax. That could go forever. Well, it could go forever up until we would click the next capital gains rate. My point is that it doesn't tier up from a rate schedule perspective. And so this is where we want to be filling these brackets to avoid these brackets. You want to fill this bracket to avoid this bracket. And that keeps then your average or your effective tax rate as low as possible. Other planning considerations. We want to guesstimate your marginal tax rate post RMDs. We've talked about that. You need to think about which road you're on. Are you a pay me now or pay me later person? Should we be adjusting income up or down, or are things just about right to take advantage of the deductions as they're being served up this year? how is it best to manage your adjusted gross income's impact to get the maximum benefit out of all those things. Remember, we looked at probably 8 or 9 items that were affected by AGI. Which of those affect you, and how do the AGI limits apply there? And then how to manage the phase out ranges. So these are all things to think about from a big picture perspective when we get into the nitty gritty. So these are the tools in the toolbox that we use most frequently. One, Roth conversions and qualified charitable donations in order to manage, either drive up or drive down adjusted gross income. If we're itemizing, we want to consider making multiple charitable contributions, hopefully with appreciated securities, to a donor advised fund. That will help avoid the statutory haircut in future years if we can get ahead of it. Of course, you want to make sure that you're making those contributions within a relatively high marginal bracket. We don't want to do that and drive down below the capital gains rates for sure, and certainly not below what your terminal tax rate will be from required distributions later in life. We want to contribute appreciated property to donor advised funds to help lower income. And if we do drive it too low, we can then turn around and refill that bracket with Roth conversions. And this helps move income out of the qualified plan so that our required distributions will be lower later in life. We want to replace gifted securities. So if we do gift securities to charity or to other generations in our family, we can replace those securities and manage our tax basis higher, which will reduce future gains. And of course, managing capital gains and losses. We regularly look within the portfolio management side of the practice at loss harvesting, but we want to make sure that if gains need to be taken to take advantage of these tax breaks, we're doing that. So that would be worth a conversation with your advisor. And we want to make sure that we're paying attention to these tax rates. And if you are going to be trading securities, we want to make sure we get the benefit of what we're doing. So we want to look out for wash sales, which basically says if you take a loss on a security, you can't turn around and replace it right away. If you take a gain, the wash sale rules don't apply. A lot of states now have certain privileges where you can make a gift. Either to Ohio in particular has what are called SGOs, or scholarship granting organizations. Other states have qualified charitable organizations, but you can make gifts to these organizations and receive a state tax credit. In other words, if you give $750, you get a $750 credit, which makes the contribution free. If you have anything that you're interested in, it's silly not to do this, because again, it is literally free. You may want to consider, if you're in the decision mode of taking Social Security and you've got these between the line deductions, you may want to consider postponing Social Security, because again, that will drive up your adjusted gross income and may push you into the phase out zones. You want to monitor the IRMA cliffs for the same reasons. We don't want to at least mindlessly trip over the cliff. And remember, that is truly a cliff. It's not a phase out where you lose a little bit for going over. $1 over and you're in that next bracket. From a financial family perspective, we want to complete year-end gifts. Remember, you can give up to $19,000 per beneficiary this year. 529 planning, not a bad time to think about estate planning and beneficiary reviews. Granted, your estate planning attorney is going to be busy this time of year, but it's not bad to review beneficiaries, things of that nature, and your advisor at HCM can obviously help you work through that. And check on employer plan retirement contributions. We want to make sure that we're not leaving any stones unturned there. If there's still more contribution room, and that makes sense, you want to do that while you still have some paychecks left. And if your income is too high to make Roth contributions, but that makes sense in your strategy, you want to consider a backdoor Roth, which basically involves making traditional IRA contributions first and then putting the money back into Roth accounts. you'll want to do some tax calculations regarding this pro rata rule, but again, your advisor can help with that. And one more click, there we go. Okay, that does it for my comments here today. Again, I want to thank everybody for your time. And the call to action here is hopefully you can see from all the things that have changed that this isn't the sort of thing you're going to do on the back of an envelope. If you feel like you would benefit from some planning, it makes sense to contact your advisor. We can get with the CPA group and get the calculations done. Again, there's very little time between now and the end of the year to make these decisions and take actions. So this is something we really need to get with. Thanks, everybody. Appreciate it. Bye-bye.